welcome. You're watching Business Today Television. I'm Sakshi Batra. This is Market Today, a show where we'll help you understand the closing action on the D Street. After yesterday's stellar move, we've kind of built on some gains today. 0.4% of an uptick right now on the Nifty. We are above 22,400, 23,400 at this point in time. A lot of stocks that are buzzing in trade. Indices Bank carries on with yesterday's move. Another 7.5-8% of a move can be seen today. Banks and financials are definitely leading from the front. You can see Axis Bank also up 4.5% higher. ONGC, Trent, Asian Paints. These are some of the top movers on the Nifty right now. On the laggard side, you have Maruti, Tata Motors, Infosys ahead of earnings, Sun Pharma, Bajaj Finance, NTPC, Hindalco as some of the top laggards at this point in time. But even the broader markets are, in a positive zone at this point in time. You can see both the mid and the small caps up and about in trade, with the small caps leading over 1% gains can be seen. Sectoral action also seems to be largely towards the positive. You have financial services, FMCG, media stocks, metals in the positive. PSU Bank definitely, which have started off with their move yesterday, continuing even today, 2.5% higher. Your private banks up by 1.8%. Realty carrying on with the move from yesterday, slightly higher in trade. Consumer durables, oil and gas also up and about. So what's not doing well today is IT again. That's soft. Autos, of course. And apart from that, Pharma. That's also slightly lower in trade, but rest of the pockets are still up and about in trade. Let's get into a conversation with our top market expert for this afternoon session. We have with us Mr. Sharad Awasthi joining in from Smiths to guide us through the market move and the key factors to look at from here on as well. Mr. Awasthi, warm welcome. Good afternoon to you. Good to have you with us. We're meeting after the 90-day pause has been announced on the tariff front. A lot of moving parts happening, so we will be touching base upon each and every point then. Beyond this 90-day pause, we've actually seen the first signs emerge on the D Street, a sign of relief across the board. But I still wanted to understand, for the larger audience's benefit, how much of the pain on the tariff front has already been priced in, and how much of it will still remain, because it cannot be so that everything is done and dusted. In the interim, we are expecting and anticipating some tariff announcements to come in sector-wise now, if not a blanket one, just like how it was announced on a 26% tariff basis.
Thank you for having me on the show. I think the first thing regarding the tariffs was that it was a negotiation tactic. So I think that's how it is playing out. And once a tit-for-tat kind of regime comes in and other countries also started bunging in, I think now it's more or less isolated on China, which was the primary objective of it. The other angle could be, protecting the fiat currency status, etc., because that's very crucial to US in the current situation. But again, as we were talking last time also, that this was such a big announcement that it could have multiple effects. You can't simply pull down the dollar. You can't simply put in tariffs and expect the industry to jump into a position that next day, because we live in an intertwined world where it is very difficult to isolate your supply chains and manufacturing. The ideal approach would have been to do it gradually. I think now they are coming back to the same page, that maybe handling macroeconomics or handling a Twitter are not the same thing. So gradually, I think they're coming back to pace. Regarding whether all the pain is absorbed, I don't think that is the case. But now more or less markets are certain that, it's not going to be a one-way ride kind of situation where tariffs will be announced and implemented without any logical thinking or without really weighing the impact of it. Because the bond markets obviously gave them a whimper of how it could pan out and how it could look like. So I think all that has played out very well. I think now, from now onwards, most probably the US announcements will also be much more sane. And some countries that had been doing excesses in terms of, trade deficits, they would also come back on the table and maybe put up a more balanced foot forward rather than an aggressive foot forward where you just subsidize your local production and eat up maximum global share. I think that's not a sustainable way when China has been facing the brunt. It's been delayed, but I don't think it's over. It will be a gradual process now. So most probably now the only respite for the markets could be, that it's not going to be one-off kind of situation where one day a trade is announced and global trade collapses. So now most probably it will be in a calibrated way. So we will not have, a blowout kind of effects. But yeah, gradual impact will be there. And now it will be more, as you rightly pointed out, sector oriented and, specific product oriented, how these tariffs are implemented on country specific items. And then from there on, we can better analyze and understand how the impacts will be, because right now what was done was a very strange issue. We had no method of really anticipating how it was going to pan out.
Absolutely right. But amidst all of this, the only thing that continues to glitter is gold. I mean, 95,000 is with us. It was just a matter of time. Now, probably seems like 1 lakh could be hit anytime soon because the prices are just not halting and the rally goes on. 25% of a rally on gold in just first the 3.5 months of 2025. Even if somebody was to invest on the 1st of January, they would have been sitting on a handsome 25% move on gold, something that we had not anticipated, that beyond such a strong rally in the previous calendar year, it could probably catapult so higher so fast in such a short time in space as well. How would you really advise the retail investors at large who are now facing a complete FOMO of whether they should be probably pulling out the money in equity, shifting in gold? All of those questions are coming into us every day. How are you advising retail investors to go about gold at this point in time? Is it advisable to invest in gold at 95,000 levels?
Well, I think no, not at all. I think gold as an asset class only makes sense as something, to diversify your portfolio in times where you think your equity or debt portfolio is at a severe risk. Uh, Debt is a different ball game, but equity I don't think is at current valuations. Indian equities per se is a very risky asset class to look at, and I think long-term growth rates would be suitable. So I think at these levels, it's better to be in Indian equities rather be in gold. And if the dollar does depreciate vis-a-vis the INR, I think that's also a negative factor for Indian gold investors. So all in all, I don't think gold has a very bullish outcome from here on. If we do hit something of a financial crisis sometime later, maybe 1.5, 2 year later, maybe that is the time you shift. And when equity valuations are high, that is the time when you shift from equities to gold. But right now, I think equities seem to offer a much better option. Certainly, the Jan to March rally has surprised me also. But the uncertainty has also been of a different level. But one part of the uncertainty, which was geopolitical in nature, which was wars and etc., tensions in some parts of the world that are coming down. So I think that would be positive. And once I think inflation and interest rate trajectory also settles down over the next 3 to 6 months, ideally it would be difficult for gold to replicate what it has done over the last 1.5 year.
Okay, got that. So that's as far as the gold expectations are. I'll now come to the key domestic triggers that we are looking at. Earnings upon us already. TCS kick started with the earnings. What's the sense that you're already getting from the initial signs there? Infosys, Wipro awaited, and of course the IT sector as a whole. What's your expectation on the IT pack? And then if you could also expound on the overall earnings, sir.
Particularly for IT Sakshi, it could be, a bit of nervousness on the future outcome that they look at, because discretionary spending is something we are not very sure. But considering the view that I'm having regarding interest rates and inflation both going down, there is a high probability that BFSI in America would do very well. There are some bets on full-blown recession in the US, which I seriously doubt. Yeah, technical recession for a short span of time is very much possible, given the way things are moving around. And after COVID, there have always been events which have caused debasing. Basically, the base effect has always cleared in, and there are a lot of things that have been disoriented because of sometime logistics, sometime a war or something like that. So I think that will play out. I think that debasing, rebasing, that will move. Means normally you can't really seasonally adjust these numbers nowadays because of so many events happening. So I think that will be a challenge, but largely, yeah, I think the IT numbers would be in line with expectations, marginally growing to flattish numbers for the quarter, and most probably the outcome will be a bit clouded. I think over the next quarter you have more clarity regarding the future outcome. So maybe the future outlook is not very robust right now, but my understanding is that over the next 3 months, as interest and inflation rates settle down, and most probably we have much more clarity regarding the tariffs also, and the tones are also much lower from particularly China and US. I think there is a high probability, that IT could recover from these levels in
Okay.
terms of quarterly numbers, and the valuations are also comfortable. And in terms of the broader numbers, I think the way advances growth have come in and the way I expect from Q1, the tax cuts to also start boosting consumption. Rural urban consumption is showing signs of relief. You have seen some of the FMCG stocks also rally back based on that. So I think the most of the pain regarding consumption is behind us. Agri growth, most probably with a good monsoon coming in, should also kick in. So maybe this time around, the Q1 could look much better than traditional Q1s, which are very slow or negligible kind of quarters. And the Q4 numbers, yeah, I think the BFSI space would look much better for the Q4. And rest of the pack also, I can't foresee, like IT would be more or less flattish. BFSI could be good. Some of the insurance numbers have been encouraging, or especially on the LI side. So I think that will continue to happen, and BFSI is a big course, So most of the NBFCs, most probably after this liquidity relaxation from the RBI, most probably they would be a bit gung ho, and most probably the MSME microfinance issues are behind us. So lending growth outlook, etc., would be much better. The return ratios that they expect to retain over the means report over the next 3 to 6 months or 9 months, I think they will be much more confident regarding that. So I think all in all, the numbers should be good. Maybe metals don't do much, but rest of the pack, I think autos largely be a domestic oriented space. Consumption coming back, two-wheelers should do good. So I can't see any reason why quarterly numbers might not surprise you on the upside. I think this could be one year where we might start with a very low, expectation, and maybe build on that expectation as the year progresses.
Okay, fair point. Since we are actually comparing ourselves with China on the tariffs front, now I think the highest tariff stands at 245% for China, sir. On syringes, on needles, 173% on lithium-ion batteries, about 160% on plastic dishes, electric cars about 150%. There's toys, puzzles, also about 145%. Vitamin C about 145%, car wheels about 73%, semiconductors 70%. So it's a broad range. I just wanted to get a sense that everybody's talking about that, we should be looking at India as a plus one strategy yet again. And, see how India can probably take advantage vis-a-vis China and vis-a-vis other countries. How are we placed on that front? How much of it is really possible that actually comes by way of positive for India in this negotiation, sir?
See, it's good to talk about, and design a theme around a story and tell stories regarding this, that this will happen, that will happen. But generally, it will be very difficult. It does means these supply chain changes don't happen overnight, and unless and until India has ready-made capacity surplus available, one basket, could be chemicals, but I mean, you need to seriously look at how it plays out. And in today's condition, to isolate China, I think is going to be very difficult for any country that plans to do that. You might not like them, but the point is that you cannot avoid them. They're a big consumer in most of the asset classes. They are a high per capita income economy as on date, and they are major producers of many rare earth and essential minerals which are needed for this transition, into the cleaner energy pack. So I think China will remain a very important country in the whole mix of global trade and balances. And I think no country at current situation, in spite of the pressure from US, would like to isolate its relationship with China. Like you look at India, we could not get most of the APIs because we were dependent on China. So active pharma ingredient, raw materials basically. So I think the dependence on China across the board is very much there. Globally, they have a major share of most commodities. So for Indian companies, like you mentioned, semiconductor. Now, semiconductor is a long gestation business, 5-7 years. We still don't have a fab processing unit here. So I think these are all long gestation units. I don't think it's going to happen in a hurry. You can do wishful thinking and try to identify a theme on that. But I don't think these broader themes work. Rather stick to the basics, have a bottom-up approach where valuations are good and you understand the story, having been doing good, to do good over the next 18 to 24 months on a domestic base. I think that helps. suddenly overnight will not become an export-led destination. I think defense is one space where we have made a lot of progress over the last 5-10 years. So that
Yes.
is one export destination that could open up for us.
Hmm.
But again, I think the complicated parts are still not there with us, and technology needs to develop over the next 5-10 years, and that will take some time with the offset clause kicking in. So direct beneficiaries, I don't think you can do it an across the board comparison. Whether China can be avoided, I strictly doubt it. Whether they can be brought a bit in line with respect to what they have been doing with respect to trade deficits and subsidizing their local production, I think
Yeah.
that is something that everyone would want to do.
Absolutely. Fair point on that front, sir. Also, just wanted to get a sense on the macro front, what we are looking at, and inflation numbers came in, of course, on a positive zone yet again. They have been inching lower, like you also pointed out, from last 2 or 3 months odd, and they are comfortable much below that the RBI band of 4% as well. Food inflation, which used to be like the big culprit, has also eased off quite a bit. Vegetables prices are now like in a deflationary category as well. We've already seen two cuts from the RBI, sir. And I want to just get a sense of now with the inflation band really coming in comfortable, looking at what the GDP estimates are being seen from across the globe, we are seeing revisions on the lower end as well. What do you think the stance of the RBI should be now going forward with inflation in a comfortable zone? Should they continue to cut rates to support growth?
Yeah, I think they'll continue to cut rates, but to cut rates in isolation without support on the US markets would be difficult for them. And the
Okay.
current situation in the US is a bit confusing. So that's the only challenge I see. I think once clarity emerges with respect to rates in the US, so maybe the first 25 basis point cut after this, you get very easy in isolation also, where we are decoupled from the US. But I think beyond that, the rate trajectory has to be in sync with what happens in the US. I think for us to, move in a very diversified fashion or in a diverse fashion vis-a-vis what US is doing would
Hmm.
be very difficult. So I think largely we would do it in sync with the US. So maybe the next 25 basis points comes on an isolated decoupled fashion where India does it on its own. But after that, I think most of it should follow suit as to what's happening internationally on the developed world.
Hmm. And what should be one's approach on banks, financials, therefore, sir? Even PSU banks have started to pick up pace over the last 2 days odd. Any suggestion on this entire front?
Yeah, I think go aggressive. I think whatever advances numbers we have seen seem like promising. The MSME microfinance book that was causing a lot of trouble, I think most of it is in the books. From here on, not much pain should come out. Rather, some improvements should come out. And you know what happens with NPAs is once the advances book starts crawling up by percentage term, mathematically the NPA percentage starts looking lower. But even in an absolute term, I think we are not seeing much pressure on the NPA side. The larger corporates are not over leveraged in India at all. So I don't think pockets here and there might happen, but I think on a larger basis as a blanket, I don't think that NPAs are going up. Sorry, and with advances, going up, there is a high probability that NPAs might look much lesser. And as this pressure comes down, I think there is a high probability that you see a strong revival across banks. On the private sector bank, I think Axis is most attractively valued at current prices. I've told this earlier also. Similarly, on the PSU side, I think most of the banks, the likes of an SBI, PNB, Bank of Baroda, all are attractively valued. What SBI maybe 1.4, 1.5
Absolutely.
last 12-month earnings, and on forward earnings you discount it by another 10-12%. So I think across the board most of the banks, the PNB, BOB, etc., most probably are trading at 1.1 1.2 times price to book, and I don't see a lot of pressure there. And once the advance book starts going up, I think there is a probability that these stocks get re-rated. The
Hmm.
small banks like the Indian banks of the world or a Bank of India, Union Bank, I think these are all excellent stories at these valuations. We do not see a lot of pressure coming into them. And on the private sector, even the small finance banks or something like an L&T Finance could do very well, with the
Okay.
NBFC relaxation coming in. Poonawalla could be a good story you could look at. I
Yeah.
think it has corrected substantially from the high level. So I think across the board, you could look at a blanket. I mean, small finance banks have been positive for quite some time, the likes of Ujjivan, ESAF, etc. So I
Hmm.
think most of the pain is behind us, and I think largely it will play according to you. So within the BFSI space, you can choose according to your risk appetite or comfort zone with respect to market caps, etc. But I think across the board, it should be a very good time for being in BFSI stocks.
Okay, BFSI stocks, it's a good time to be in at this point in time as well. So we'll keep an eye out on this space. You were mentioning about the defense names, sir. Wanted to also just pull in the railways pack there. Today there was a movement across the space in trade today. What's your approach on the railway space? Do you still feel we are far away from again retesting those all-time highs that we touched in the past? Probably the valuation still needs to find that merit.
No, I think for the railway stocks, it will be a bit difficult. Unless and until something like an RVNL, translates some of the big order wins that we have been talking about internationally, particularly not at the domestic level. Though in terms of railway expenditure, it would continue to grow at a rapid rate. But even at these valuations, I think you would find it difficult. IRFC is one idea we were pitching on, but now they are also looking at non-railway funding businesses, which in case of any NBFC, when it's a new business, you have the risk of NPAs, etc. Till now, IRFC did not have that risk, so you could value it even on a PE basically. But now I don't think that is the case. So that risk comes into place. So you boil down back to price to book multiples, etc., or do an SOTP on both businesses. But largely, I think it would be very difficult for most of the railway stocks, to continue raking this up, because even with good growth rates, I think you are largely discounting 2.5 years forward easily for most cases. And unless and until some big international order win converts, there is very low probability that you'd see a strong re-rating in railway stocks.
Okay, fair point. Let's actually look at some of the strong moves that we are seeing in the broadest index today. JBM Auto is now 10.5% higher in trade. DOMS Industries is also up by about 9 or 10% odd. You have NBCC that's rallying 7%, NTPC Green that's rallying in trade. Irida that's up and about after earnings. There's MCure Pharma, IndusInd Bank, SW Solar. A lot of these renewable energy names also flying away, sir. Theme that's erstwhile favorite coming back into fore, do you believe?
Yeah, I think with the current valuations, if you look at an Inox Wind or say a Sterling Wilson Solar, though Inox Wind would report, maybe has already reported numbers, and most probably the growth rates would be very good. So we are working with targets of around 240. SW Solar, there is a bit of risk because most of the larger projects that they have been talking about, most of them have not converted till now. Reliance has not really come out with a very big commitment regarding the renewable part of it. That could have been a big order accretion for them. So I think there are a bit of variables that are not probably falling in place just now for Sterling Wilson Solar, but I think any of it, which is the battery storage project in Africa, I think these are all big projects. If any of them converts, it could be a very big winner. And at these valuations, I don't think it's very stretched. I believe it's 250, 260. It's come down substantially from the highs of around 750. So if someone wants to take a bit of risk, I think that SW Solar certainly does make the cut. And if you want to, take a lesser amount of risk and high growth, I think Inox Wind is a good story at these valuations.
Sorry, another big figure that I was hoping to understand from you is that came in by way of IMD's expectations. I mean, the first expectations that they have put out of above normal rainfall for southwest monsoons, and they are deputing about a 60% chance to an above normal rainfall. This is the first expectation that they've put out, with inflation inching down, and monsoons also probably coming in above normal. What's the probably strategy in the short to medium term that investors should have? Should one really again look at fertilizers, chemicals, agri names at this point in time, a pure domestic name, probably to safeguard their portfolios at this point, sir?
No, I'm not in support of this, go purely domestic kind of story, because I don't think in this world you can really find a pure domestic story. If you do find, it will be a very small one. So I think it does not make sense. Everything is very interconnected, whether it's your raw material side or the supply side or sales side. So it will be very difficult to find ideas which are just, purely sourcing within India and selling within India. Largely the scale would not be there. So I think we live in an intertwined world. It would be very difficult to find domestic stories. But whether you should go in for the fertilizer stories, I think across the board, the type of rally that fertilizer stocks have seen, I think largely they are factoring in two things. One is lower raw material prices because of easing Russia-Ukraine tensions, and the other is lower logistic costs because of reducing tensions in the Red Sea zone, and the third could be lower gas prices. So I think all three are very big triggers for these stocks. And Coromandel had come out with a very aggressive, advance forecast, etc., for their numbers and the type of growth and ramping up of some of the businesses. So all that is played out, I think, but at these valuations, I would not be very comfortable buying a Chambal or even, uh, Coromandel. But maybe with a big capex on the sidelines, Deepak Fertilizer could be a good idea to look at. But again, I think there has been a bit of run up, and I would like to be a bit conservative. So maybe for 10-15% another upside, a Deepak Fertilizer could be a good bet in the short to medium term. Long term, yeah, I certainly think with the capex, etc., playing in, I think Deepak Fertilizer would be my best bet within the space.
Okay, fair point. And lastly, Mr. Steve, I have to ask you that, of course, like we have been discussing, that one has to continue to maneuver through the uncertainties that might come. It's not that all the pain is done and dusted and we are out of the worst at this point in time. Looking at all of these aspects and how things are moving at this point, what is the advice to a retail investor who's holding on to cash, say about 10 lakh rupees? How does one really go about the allocation right now? Going about selecting sectors, stocks, asset classes, what's the right mix, so that by the end of FY26, you still are better off, even if one has to moderate the expectations from the markets, but you're still better off and have generated some kind of an alpha.
Uh, I think the ideal approach would be to, to invest gradually and do not get perturbed by, corrections in the market. So supposedly you are following the Nifty. I think you stagger your investment over the next 500 points. Every 500 points, you invest another 25%. Create a basket of 10, 11 stocks. And every time, rather than worrying about the weightage, you just put an equal weightage on all these stocks and invest that money. So every 5% fall, you invest around 25%, which is around 2.5 lakh spread across 10 stocks, which could be around 25,000 per stock. You're new into it, you're not sure. I think go with large caps only. And if you think that you have done your research properly, or you can believe on an advisor that you have, you could stretch your portfolio into mid caps, small caps.
Okay, fair point, Mr. Vasi. Well, we'll thank you on that note for being with us on the closing edition and helping us navigate through all these uncertainties. And we hope that we find you in even better times as we meet next. Things are improving gradually, and we hope that things turn out to be even better. And we are headed into a long weekend, and maybe things get back on track after that too. Many thanks for being with us on the show, sir, and explaining to us, the right way of looking at markets and allocations at this point in time. All right, viewers, we'll start wrapping up the closing trade now. 23,450 with us. We are 122 points higher. Remember, we started on a dicey note, slightly on a muted and a negative note, but we are ending almost near the day's high. You can see a 0.5% uptick on the Nifty. It's the Nifty Bank, clearly to be thanked for today. That was the index that went on full throttle, 777 points higher, 53,156. The Nifty Bank led by large private sector banks, PSU banks, financial services, all in tow, really leading to the fresh momentum. This has clearly emerged as the clear consensus buy in this current environment, and where the outperformance could definitely lie at this point in time. Let's look at the broader markets. There has been a slow gradual improvement towards the day's high for the small caps, up over 1%. Mid caps also up by about 0.7%. So that's also inched up higher in trade. Like I pointed out, sectoral action. When we look, we have seen slight dips on, say, autos and on IT, on pharma index, on healthcare index today, but rest of the pockets still hold up, especially the banks, oil and gas, consumer durables, the realty pack. That's the space that to look at. PSU Bank now end up 2.4% higher. Media stocks are up in trade, 0.5% uptick even for the FMCG space. So that's how the sectoral action has panned out really. Nifty next 50 names are up by about 0.5%. We're also seeing the Nifty 500 stocks by about 0.5% higher. There are many stocks that are inching up, 10, 20% up in trade in the broadest index. So very, very strong names that can be seen. JBM Auto ends 11% higher. GMDC, DOMS, Engineers India. Then you also have NBCC, NTPC Green, MCure, SW Solar, Irida, JNK Bank, Sundaram Finance. Most of these names we have actually discussed throughout the course of our conversation in trades today. Let's also look at what's really happening in the small caps basket. That's the one that's really moved up 1% higher. It's better off performing index. So within the small caps also, interesting names like ITI, for instance, KFinTech, EMS plays definitely coming in to fore. You have Pharma, Aegis Logistics, Karur Vysya Bank, Natco Pharma, all of them also coming back to shine a lot. I mean, gold prices definitely were something that have been the highlight of the trading session today. 95,000 coming in. Most of the experts are already penciling in $3,500, $3,700 an ounce over the next course of 1 year. And of course, they're also anticipating 6,000 to 7,000. There are brokerage houses even indicating $8,000 on gold over the next 4-5 years or so. So the rally could have just started as per some of the estimates that are coming in at this point in time. Okay, we'll wrap up the trade right now. On your screens, the final print on the Nifty 23,433. And we have one more trading session to go for this week, now tomorrow. 2 days of gains is what we've already had. Yesterday, a stupendous move, and today, slowly and gradually, we've consolidated above the levels of even yesterday. We have recovered most of the losses. In fact, all of the losses that had been incurred after April 2nd announcement of the tariffs. And let's hope that things only turn out for the better going forward from here. We'll leave it to at that, viewers, but do stay tuned on Business Today Television as the action continues on the other side of this break.
What does the post-tariff world look like? Lots of conversation the world over around how this impacts the United States, India, and economic growth in other countries. To talk about what to expect from here on, we're joined live and exclusive on the news track by one of the world's sharpest economic affairs commentators, Martin Wolf from the Financial Times. His articles and thoughts are very closely tracked the world over, so we're very delighted at a time of so much uncertainty. Mr. Wolf,